Okay, good day everyone. Welcome to another edition on strategic financial management. In my previous lecture, I've been able to explain some of these terms, but today we shall continue from assumption of capital asset pricing model. Now, limitations of capital asset pricing model. If we can recall that capital asset pricing model is one of the methods of calculating cost of equity, right? Which is the cost, it is the cost to the firm, it is the return to the equity holder. Now, one of the limitations of this model is that beta factor is unstable over time, and which is true because beta factor is measures risk, right? Beta factor measures risk, and this type of risk they are unstable. For instance, systematic risk is not stable, right? Looking at what is happening in what in our economy, right? What happened last year is different from what is happening this year. Now, it only considers systematic risk. Now, the only risk that capital asset pricing model consider is only systematic, which is very wrong. Recall that systematic risk is a risk that affect the general economy. Now, what about the unsystematic risk? What about the unsystematic risk or diversifiable what risk, right? What are all those risks, right? So it's one of the limitation. It only considers systematic risk. Now, another limitation is that data estimated from historical data may not be appropriate when considering future investment decision. Yes, because risk changes, right, in day to day or on a yearly basis, right? The inflation of as at last year in the Nigeria economy is different from inflation this year. So it changes. So it can be difficult for us to estimate the future what investment decision. Now, another limitation is it is a single factor model, right? When they say something is a single factor model, is that means that and it is not a portfolio, it's an individual required return, right? It is a single factor model. What it means is it's an individual, it is not a portfolio, right? You can decide to buy Fidelity Bank shares. You are expecting return. It's an individual return on the investment, not a portfolio, right? That is, it does not create a portfolio. Now, in practice, the risk-free and the market return, it's difficult to ascertain, which is very true because how do we determine the risk-free and the what and the market return is very difficult. Mostly is an assumption that risk-free is 2%, right? Now, better. What is better? Better measures systematic risk. What are these systematic risks? Systematic risks, I've explained earlier actually, is a risk that affects the general economy. You talk about the inflation, you talk about the exchange rate, you talk about the government policy, right? For instance, CBN recapitalization, right? Now, a beta greater than one indicates that a company stock price is risky. That is it. Because when you see a company beta is greater than one, which means that the company stock price is prone to risk, and we should expect higher return. The higher the risk, the higher the what return. Because we are talking about what equity, right? Now, why when a beta is less than one, you could be asked that what beta when beta is greater than one, what does this implies? When beta is greater than one, what does this implies? So when it is less than one, it indicates that the stock price is what is less risky in the what in the overall market, which means that the stock price in the market it is not a risky what stock. Now, when it is not a risky stock, you should what you should expect a lower what a lower return, right? Another thing we should look at is the capital market line. Now, capital market line is the combination of risk and return of those portfolios that are efficient, right? Market line, capital market line is the combination of risk and return of those portfolio that are efficient. Now, this combination of risk, it is both systematic risk and unsystematic risk. Now, why the return of this portfolio is the what? Is the expected return of the portfolio. For instance, now, you invest in Orlando shares, Unilever, and Fidelity Bank. That is three portfolio. Now, your portfolio, your expected return on that portfolio, right, will be compared with this combination of risk. Now, this combination of risk, it is both systematic risk that affects everybody, right? Every companies, right? And also unsystematic risk. Now, what are unsystematic risk, right? Risks that can caused by an organization. I've explained that in my previous lecture, right? Now, that are efficient. Now, what is efficient portfolio? Now, you will compare your expected return and the risk, then you will know if your portfolio is efficient or inefficient. Now, the question is, what is efficient portfolio? Now, efficient portfolio is when the total risk, right? When the total risk, right, is actually less than, right? Is less than the expected return, right? Is less than the what? The expected return. You could say your portfolio is efficient, right? When the total risk, both systematic risk and unsystematic risk, is less than your expected return of the portfolio, you could say your portfolio is efficient, right? Expected return is the total return you are expecting from that three portfolio, as mentioned earlier. Now, the total risk, right, is the combination of systematic risk and unsystematic risk and unsystematic what? Risk. Now, having explained the capital market line, you could say that capital market line is explaining the concept of portfolio theory because it deals with what? The total risk and also portfolio expected return of what? Of portfolio. Now, security market line. What is security market line? Now, security market line measures the relationship between the individual required rate of return and investment risk, whether efficient or inefficient. Now, security market line is talking about individual expected return. When you invest in Fidelity Bank shares, you are expecting something from your what? From your investment. Minimum amount you will get from your investment, right? As an individual. And what? Investment risk, right? Investment risk in this context is systematic risk only. Now, guess what? Which of the model considers systematic risk? It is capital asset pricing model, right? This to tell us that the security market line is explaining more of the what? Of the model of what? Capital asset pricing model, right? Security market line explain more of what? CAPM. Now, having explained this, we can see the formula that it explains more about the what? The capital asset pricing model. Now, having explained this, we shall proceed with capital asset pricing model. Now, we can see capital asset pricing model could be is also known as individual required rate of what? Return, because it is a return to an individual, right? To individual investment, right? And it is the cost to the firm. And this is the formula of capital asset pricing model. Cost of equity equals to risk-free plus beta market return minus what? Minus risk-free. Now, capital asset pricing model is used to determine the minimum individual required rate of return. This is the formula to calculate the individual required rate of return using the capital asset pricing model. Now, it could be this or this. It depends on the parameter given in the question. It could be cost of equity equals to risk-free plus beta times the risk premium. In every question, in some questions, you may be given risk premium. So this is risk premium, yeah. So this can be used to determine the individual required rate of return. Don't forget, please. The required rate of return is the capital asset pricing model, right? And this is the formula. Cost of equity, risk-free, is also known as treasury bill, as explained in my previous lecture. Government bond, right? Equity beta and market return, risk-free. Now, in a question, the beta factor will not be given, which is the risk, which is the systematic risk of the individual required rate of return, which is the CAPM, may not be given. So what will you now use to determine the beta? There are two formulas here. It depends on what is given in the question. One, we have coefficient of portfolio, right, of investment A may be given in the question, and standard deviation of the project, which is the standard deviation, the risk of the investment, right, divided by the standard deviation of the market return. So it depends on what is given in the question that you will know either you are going for the first formula or the second formula. Now, if you are given the covariance, right, of the investment, so it means that you use formula 2 to determine the what? The equity beta. Sometimes equity beta may be given in the what? In the question. Now, the standard deviation of the market times standard deviation of the market return. So this could be square actually. So it depends on the parameter given in the question. Either you are going for formula 1 or formula 2. So remember, beta may be given and may not be given. So if it is not given in the question, you use either of these two formula. It depends on the what? The parameter. Now, we shall move to another formula, which is what? Formula for calculating expected return. It's also known as equity forecast. Now, your expected return, it is your future return on investment, right? Now, and your future return on investment could be either dividend or capital appreciation. Now, expected return may not also be given in the question. Expected return could represent an upside potential in valuation, right? Now, expected return may not be given in the question. Now, expected return will be calculated using three formulas. Now, the first one is capital gains if it is given plus dividend, right? Or if this is not given, you can check for this as forecast stock price minus previous stock price divided by previous stock price, right? Forecast stock price minus previous stock price plus dividend divided by the previous stock price. Now you check if expected price is given. Expected price minus current price divided plus dividend divided by the current price. Now the EV represents the opening or the ending, right? The ending what? Stock, which is what? The inventory, while BV represents the what? The beginning, which is the previous what? Year. Now, that is it. Now, what do we want to achieve? Remember that you first of all determine the individual required rate of return using the capital asset pricing model. Second, we determine what the expected return if it is not given in the question. You check what is given in the question using any of these parameters, right? They may give you forecast stock price or capital gains. You check from the question, right? Now, having achieved that, we want to explain now alpha, right? Alpha is the abnormal return, that is the difference between the expected return and individual required return class. Now, expected return will not be given in the question, and we have the formulas for calculating what expected return, right? Okay. Alpha is the abnormal return, that is the difference between the expected return and individual required return. Now, recall that this is the expected return, right? When it is not given in the question, you use these three formula to determine the what? The expected return, right? Use any of these three formula. Check from your question if capital gains is given, right? Gains on what? Disposal of what? Of an asset plus the dividend, right? So you check. Now, the individual required return is talking about what? The capital asset pricing model, which means that the difference between the expected return, individual expected return, what you are expecting from your investment, right? From your future investment, and what? The individual what? Required return. The difference we give what? Alpha. Alpha what? Alpha value. Now, when expected is greater than what? The required return. What it means is that you buy more of this stock, right? You buy more of it because your expected return, what you are expecting in the future, is greater than the what? The minimum required return. You should buy more of this stock. But when expected return is lower than required return, what it means is that you should sell that particular stock because what you will get in the future is lesser than the minimum required return. What it means is that you have to do what? You have to sell that particular stock because it does not worth keeping it. But when the expected return is equal to the required return, what it means is that you an investor have the decision to make, either to buy or sell or to hold. So the decision here is to hold that particular stock. You should not buy nor sell. Now, expected return minus required return, we give alpha value, right? We give alpha value, and alpha value could be positive or negative, right? Could be either you buy or you sell or you hold. That is what it means. Now, example now. A practical illustration is here. This is three portfolio. Now, this is expected return. What is expected return? Firstly, expected return is the future return on investment. Now, as an investor, you are expecting dividend in the future or capital appreciation. That appreciation means that increase in the share price, the market price, right? That is what? The capital appreciation. Now, that is expected what? A return on what? On investment. Now, what is a required rate of return, which is CAPM? Now, is the minimum you can get. Peter asset pricing model is is a method of calculating cost of equity, right? Now, that return is the minimum you are expecting it. It is not that you may get, you may not get. It depends on what the company make in that year because they have to settle debt holder before the equity holder. Now, the minimum amount you can get from that your investment that you are expecting is the required rate of return. The minimum, that is the lowest amount that you can get, right? Because you are expecting it. You don't have, like, you don't need to say, you are expecting 5 million. No, it is the minimum that you can get from your investment. Now, let me use this as an illustration. Now, this is expected return of 50. Now, your future return on investment, right? Your future return on your investment is 50, right? Now, the minimum, which is the required return, that the lowest you can get from that your permutation, from that your expected return in the future, the minimum you can get is what? Is 30. Now, this is to say alpha is what? Alpha is positive, which is the difference. What it means is that the stock A is undervalued. Now, why is it undervalued? Because you will still get a minimum. You still get it does not you will still get your what? Your minimum return on your what? On your investment. Because an investor, an equity holder is expecting a minimum return on the investment. Is minimum. That is all what equity holder are expecting from their what? Investment. So if you can get a minimum of 30 from your what? From your investment, yes, the stock is undervalued. You can go ahead and buy more of this stock. That is the recommendation. Now, why in stock B? Now, what you are expecting in the future is 50, right? Now, the minimum you can get is 60. Now, how can you, where will you see 10 to complete this minimum amount? Where will you see it? When you are expecting in the future of 10, and the minimum you could get, minimum, the lowest you could get is 60. So where will you get it? So what it means is that that stock does not worth keeping it. Now, the alpha will becomes negative, right? That means that the alpha is what is overvalued. The stock price, the stock is what overvalued. You don't need to keep it. You have to sell. Now, let me use a practical illustration here. Now, you buy Fidelity Bank shares and you are expecting, you do your valuation and you are expecting 50, right? From your investment in the future, right? Now, the minimum you could get from your capital asset pricing model, the minimum you could get is 60. You can see that there is a problem. Why? Because the minimum you could get is higher than what your valuation is saying. So what it means is that where will you get the 10 to complete the minimum return? So there is no 10. You can't get that 10. What you need to do is that the stock, what it means is that the stock has been what? Has been overvalued. You have to sell, quickly sell that particular stock because it does not worth keeping it. When you keep it more than that, you may lose a lot of what? Money. Now, see, when you have your future return on investment and the minimum you could get is equal, right? Now, the decision here is that you should hold, you should not buy or no what? Sell. So that is what alpha is explaining. Now, in a nutshell, alpha is explaining more of the concept of the capital asset pricing model. Remember, your expected return may not be given in the question, which means what? We have the formula to calculate the expected return. And again, the required return may also not be given in the question, right? Which is the CAPM. You use your CAPM. And don't forget, beta factor may not be given. You use this to determine the beta factor. Now, having explained this, we shall move toward the portfolio theory. Now, the question is, what is portfolio theory? Now, portfolio, as explained earlier, is the combination of different investments, right? Investment in stock, investment in bond, investment could be what? Capital project. Now, to minimize investment risks, right, and maximize investment return. Why? Because every investor wants to minimize risk. That is why they have to diversify, right? They need to what? To diversify, to minimize their what? Their investment risks. To minimize investment risk and maximize investment return. Now, that is why, because some investors are risk adverse. So that is why you see them building a portfolio. Now, expected return of two portfolio will be calculated as WA times RA plus WB times RB. Now, what this means is that WA WA represents the percentage amount you invested in stock A. WP means that the percentage you invested in stock B. Now, let me give an instance here. You invest 100 naira, 50 naira for stock A, and 50 naira for stock B, right? For stock B, right? Now, if that should be the case, that is 50-50%. So that is the percentage you invest in stock A and the percentage you invest in what? In stock B, right? Now, why RA represents the expected return on investment? Of course, I've given us the formula to calculate the expected return, right, of investment. You can see this is the formula to calculate what? The expected return. Now, the expected return on investment in what? In stock A, right? In investment A. Expected return in B, which is what? The RB. Now, notes WA plus WB equals to 1. That is how portfolio is. This is where the problem lies. Now, WA plus WB equals to 1. What it means is that weighted average, the amount you invest in stock A and B is always equals to 1. The weighted average of a portfolio is always what? Equals to 1. Now, you cannot have two unknown in a question. Now, the expected return may be given that, okay, you should determine the percentage invested in stock B. So how will you do that? How? So what you need to do is that you should make this the subject of the formula. You should make this the subject of the formula and say that you are making WB the subject of the formula, right? Which means that you need to get WA. So once you get WA, you can be able to get what? WB. Now, WB equals to 1 minus WA, right? That is it. 1 minus what? W